Hello, a pleasant afternoon to each and everyone. This is Joanne welcoming you for today's webinar. Along with me is Ms. Sultana and Mr. Ajaz Alam to address your questions that you might have during the session. So I would like to give you a brief overview of our organization. So AMCA, Abdullah Al Marzuki Chartered Accountants, is a leading auditing firm in the UAE with a decade-long experience. We are registered with the Ministry of Economy to operate as a licensed auditor as well as a tax agent from Federal Tax Authority. We are also listed with the mainland authorities and all major free zones. For this week's session, we will be discussing the fundamentals of corporate tax. You may send your questions on the message box below and we will address it to the best of our knowledge on the second half of the session. So for our webinar pointers for today is regarding tax registration, tax deregistration, tax returns and clarifications, and violation and penalties. So first, we will discuss the Article 51, which is tax registration. So any taxable person shall register for corporate tax with the authority in the form and manner and within the timeline prescribed by the authority and obtain a tax registration number except in circumstances prescribed by the minister. The authority shall, at its discretion and based on information available to the authority, have the ability to register a person for corporate tax effective from the date the person became a taxable person. So this article provides for an obligation on taxable person to register for corporate tax with the authority and provides the basis for the authority to require certain exempt person to also register. It further provides the authority with the discretionary power to register a person for corporate tax. So once registered, the person will be issued with a tax registration number by the authority, as you can see in the attached sample. So this number is unique to each person and forms part of the person's identifying information when engaging with the authority. For example, when filing a tax return. So generally, all taxable persons are required to register for corporate tax purposes. However, the minister may exclude certain categories of taxable persons from the requirement to register. In this regard, Ministerial Decision Number 43 of 2023 concerning exception from tax registration for the purpose of Federal Decree Law Number 47 of 2022 on the taxation of corporations and businesses has specified that the following persons are not required to register for corporate tax purposes. One is a government entity. So these are the federal government, local government, ministries, government departments, government agencies, authorities, and public institutions of the federal government of local governments. The second one is a government-controlled entity. So this is wholly government-owned companies carrying sovereign mandated activity and listed in cabinet decision. The third one is a person engaged in an extractive business. So this includes water, oil, gas, coal, naturally formed minerals, and other non-renewable, non-living natural resources that may be extracted from state's territory. Fourth one is a person engaged in non-extractive natural resource business. So these are the business or business activity of separating, treating, refining, processing, storing, transporting, marketing, or distributing the natural resources of the state. And the fifth one is a so for the fifth one, a non-resident person that derives only state source income and does not have a permanent establishment in the UAE. So for example, ABC company from UK sells goods to UAE company and have no place of business in UAE. So then ABC company will not be subject to corporate tax registration. So the ministerial decision also confirms that the requirement not to register for corporate tax purposes tax only applies to the extent that the above person are exempt for corporate tax purposes, where any of this person undertake a business or business activity that is subject to corporate tax, they will need to register for corporate tax with the authority. So there are certain categories of exempt person that will be required to register for corporate tax and obtain a tax registration number. This requirement will apply to any of the following type of exempt persons. First one is a qualifying public benefit entity. So these are the established for promotion of social welfare or public benefit activities such as religious, charitable, scientific, athletic, educational, healthcare, and etc. The second one is a qualifying investment fund. So any entity whose principal activity is the issuing of investment interest to raise funds or full investor funds, or establish a joint investment fund. The third one is a pension or social security fund that is subject to regulatory oversight of the competent authority in the UAE and that meets any conditions that may be prescribed by the minister. Fourth one is a juridical person incorporated in the UAE that is wholly owned and controlled by an exempt government entity, a controlled entity, a qualifying investment fund, or a pension or social security fund. The last one is any other person as may be determined by a cabinet decision. So the authority shall, at its discretion and based on information available to the authority, have the ability to register a person for corporate tax effective from the date the person became a taxable person. Okay, moving forward with tax deregistration. So a person with a tax registration number shall file a tax deregistration application with the authority where there is a cessation of its business or business activity, whether by dissolution, liquidation, or otherwise, in the form and manner and within the timeline prescribed by the authority. So a person registered for corporate tax purposes can only be deregistered once this person has paid all corporate tax and administrative penalties. So meaning, a taxable person may not be deregistered unless it has filed all tax returns due. These tax returns include the tax return for the tax period up to and including the date the person ceases to exist or operate. So next, let's talk about tax return. So the authority requires a taxable person to file a tax return for each tax period. And this tax return must be filed no later than 9 months from the end of the relevant tax period. As an example, the tax return for a tax period ending 31st December in year 1 will need to be filed by 30 September in year 2. Given corporate tax is imposed on annual basis, it is necessary to specify a tax period that applies to each person. Generally, a taxable person's tax period is the period of 12 months ending 31st December, unless the taxable person prepares financial statement using a different time period. So the financial year of taxable person is the Gregorian calendar year, or the 12-month period for which the taxable person prepares financial statements. On this basis, if taxable person does not already prepare financial statements, they will by default have a January to December tax period. So can a taxable person change of tax period? The answer is yes. Taxable person may change its financial period during its business operations. Example, after an acquisition or merger to align the financial year with its new parent company, the corporate tax law permits a taxable person to substitute a different 12-month period as their tax period with approval from the authority. So, taxable person allows to make an application to the authority to change the start and end date of its tax period to another 12-month period or to use a different tax period. This application may be subject to the conditions to be set by the authority. So, subject to Article 51 of this decree law, a taxable person must file a tax return as applicable to the authority in the form and manner prescribed by the authority. The tax return shall include at least the following information as applicable: the tax period to which the tax return, the name, address, and tax registration number of the taxable person, the date of submission of the tax return, the accounting basis used in the financial statements, the taxable income, the amount of tax loss relief claimed, the amount of tax loss transferred from other group company or transferred out to other group company. the amount of withholding tax credit and foreign tax credit, if any. Last one is the amount of corporate tax payable for the tax period. So a taxable person shall provide the authority with any such information, documents, or record as shall be reasonably required by the authority for the purposes of implementing the provision of this decree law. So, taxable person may be also required to prepare and maintain financial statements that are audited, or to have the financial statement used for determining their taxable income certified by a licensed public accountant. In this regard, Ministerial Decision Number 82 of 2023 on the determination of categories of taxable persons required to prepare and maintain audited financial statement for the purposes of Federal Decree Law Number 47 of 2022 on the taxation of corporations and businesses has specified that the following persons are required to maintain audited financial statement. First one is a taxable person deriving revenue exceeding 50 million during the relevant tax period, and the second one is a qualifying free zone with their related parties. If a taxable person is requested by the authority to provide a copy of the master and the local file to the authority, these documents must be submitted to the authority within 30 days following a request by the authority or by such later date as directed by the authority. So for the record keeping, so a taxable person obliges to keep all documents and records that support the information provided in the tax return or any other document filed with the authority and that enable the taxable income of the taxable person to be readily ascertained by the authority. So for the record-keeping obligation of a taxable person under the corporate tax law, where applicable, businesses are required to keep records such as, first, a cash book recording daily sales including credit sales. Second one is a salary and wages register if the business has employees. The third one is related records that support the information provided in the tax return or other documents filed with the authority. The last one is any other records that will allow the taxable income to be calculated. So further requires these records and documents to be maintained for 7 years following the end of the relevant tax period to which they relate. On the other hand, it is required also as an exempt person to keep any information, accounts, documents, and records to enable the exempt person status to be readily ascertained by the authority. Similar to a taxable person, an exempt person should also keep such records for 7 years following the end of the tax period to which they relate. Am I audible? So, failure to comply with the conditions may result in penalties being imposed in accordance with the provisions of the tax procedures law. So next, the taxable income of each taxable person shall be determined separately on the basis of adequate standalone financial statements prepared for financial reporting purposes in accordance with accounting standard accepted in the state. So a person may prepare financial statement using the cash basis of accounting in any of the following instances. First one, where the person derives revenue does not exceed 3 million. And the second one is in exceptional circumstances and pursuant to an application submitted by the person to the authority. So next, let's talk about the assessment of corporate tax and penalties. So a corporate tax assessment may be issued to a person in accordance with the tax procedures law, the executive regulations to the tax procedures law, and other implementing decisions relating to enforcement of tax procedures law. So, corporate tax is normally self-assessed, which means that the responsibility for calculating the taxable income and the corporate tax payable in the first instance rests with the taxable person. However, the authority should be able to issue an assessment in the course of administering and enforcing the corporate tax law if a person does not self-assess their corporate tax liability. For example, in the absence of filed tax return. So, in order to ensure the proper functioning functioning of the corporate tax system, it is necessary to empower the authority to issue and impose administrative penalties in respect of the failure to comply with the obligations set out in the corporate tax law, the tax procedures law, and other related legislation. So in this respect, it clarifies that any applicable penalties and fines to be imposed for violating any provision of the corporate tax law are determined based on the tax procedures law and any associated implementing decision. So moving on, we will be discussing the table of violations and administrative penalties annexed to Cabinet Decision Number 75 of 2023 on violations related to the application of Federal Decree Law Number 47 of 2022 on the taxation of corporations and businesses. First one, failure of the person conducting a business or business activity or having a tax obligation under the tax procedures law or the corporate tax law to keep the required records and other information specified in the tax procedures law and the corporate tax law. So one of the following penalties shall apply. First one is 10,000 for each violation. Second one is 20,000 in each case of repeated violation within 24 months from the date of the last violation. So next, failure of the person conducting business or business activity or having a tax obligation under the tax procedures law or the corporate tax law to submit the data, records, and documents related to tax in Arabic to the authority when requested. So the penalty amount will be 5,000 AED. Third one is failure of the registrant to submit a deregistration application within the time frame specified in the corporate tax law and its implementing decisions. The penalty will be 1,000 AED in case of late submission of the application, and on the same date monthly up to maximum of 10,000. So fourth one, failure of the registrant to inform the authority of any case that may require the amendment of the information pertaining to his tax record kept by the authority. So one of the following penalties shall apply: 1,000 for each violation, 5,000 in each case of repeated violation within 24 months from the date of the last violation. Next, failure of the legal representative to provide notification of their appointment within the specified time frames, in which case the penalties will be due from the legal representative owned funds. So the penalty will be 1,000 AED for this one. Next, failure of the legal representative to file a tax return within the specified time frames, in which case the penalties will be due from the legal representative owned funds. So one of the following penalties shall apply. First is 500 for each month for the first 12 months. And second one is 1,000 for each month or part thereof from the 13th month onwards. So this penalty shall be imposed from the day following the expiry date of the time frame within the tax return, must be submitted on the same date monthly thereafter. So next one, failure of the registrant to submit a tax return within the time frame specified in the corporate tax law. So one of the following penalties shall apply. First is 500 dirham for each month or part thereof for the first 12 months. Second one is 1,000 AED for each month or part thereof from the 13th month onwards. This penalty shall be imposed from the day following the expiry date of the time frame within the tax return, must be submitted, and on the same date monthly thereafter. So next is a failure of the taxable person to settle the payable tax. So the penalty will be a monthly penalty of 14% per annum for each month or part thereof on the unsettled payable tax amount from the day following the due date of payment and on the same date monthly thereafter. For the purposes of this penalty, the due date of this payment in the case of the voluntary disclosure and tax assessment shall be as follows. First, 20 business days from the date of submission in case of voluntary disclosure. The second one is 20 business days from the date of receipt in the case of tax assessment. So the last one, the registrant submits an incorrect tax return. So the penalty will be 500 dirham unless the person corrects his tax return before the expiry of the deadline for the submission of the tax return according to the corporate tax law. So that's it for our webinar for this week. You may now send your questions on the message box below and we will address it to the best of our knowledge on the second half of the session. Thank you.